Welcome to the second in our series of financial literacy videos that we're doing to try to help our clients and help Americans understand how much money they've been losing because they believed what we've been told our entire lives. So today we're going to talk about the history of stock market average returns versus stock market actual returns. So at KJ Financial, our ultimate goal is to protect and grow America's wealth one client at a time. And we found one of the best ways to do that is to help America boost their financial literacy. Now, look, you might feel that you're well versed in financial things. I did too many years ago. Unfortunately, we've been misled in so many key areas. Glad you're here so you can find out where those areas are, and then you can begin to develop strategies in recapturing the hundreds of thousands, if not millions of dollars in wealth that you've lost thanks to the biggest financial lies that we've been told our entire lives. So let's expand on our average returns versus actual returns discussions we had in the previous video. If you haven't seen it, you can find the link in the description below. Please go back and watch it first. It has a lot of context that I think you'll need that will help you really grasp this topic. So when Wall Street espouses the market has averaged 9% or 10% or more per year over time, they're talking about average returns, which is the sum of all the returns divided by the number of years you're looking at. It's a simple average, a math term, if you will, not a money math term. Now, as you can see, since 1900, the Dow Jones has averaged 7.4% without dividends. If we use average dividends from the past 20 years, we could say that's another 2%. That gives us about a 9.4% average return over time, just like Wall Street wants you to believe. The problem is when we put money to the equation, the actual return or compounded annual growth rate is only 5.2%. Adding the 2% dividends gives us an actual return of 7.2%. Well, that's 23.4% lower. Is that a big deal or not? Look, we've done just a hypothetical analysis of 20 years, 40 years, and 70 years. Why 70 years? Well, look, if you began working and saving for retirement at age 20 and you lived until age 90, assuming you didn't outlive your money, isn't that 70 years of believing the market is delivering you 9.4% instead of 7.2%? So hypothetically, assuming you had $100,000 over 20 years, you would have lost $201,346 in wealth. That's 33.39%. You see how that's growing? We went from 23.4% lower over 20 years to now losing 33.39% of our ability to build wealth. Over 40 years, you've lost $2,022,994 in wealth. That's 55.63% less. Over 70 years, you've lost $40,862,554 in wealth. That's 75.88% money. Your ability to build wealth, you've lost that by believing average market returns over actual market returns. Now look, you tell me, is that a little bit of money or a heck of a lot of money? So when you watched our first video on average returns versus actual returns, you saw where if we can avoid losses and still grab gains when things are good, your investments tend to be much more efficient. We call it safe and productive growth. Now look, safe and productive growth really wasn't available until a little more than 20 years ago. While these strategies have always been safe, in history, they weren't necessarily overly productive. Right? But luckily, like with most things, innovation has led to vast improvements, and today's strategies provide the opportunity for them to be much more productive. We've seen today's strategies, looking back, having delivered up to double-digit actual annual returns. Now, I'm not going to say that they're doing that in the future because historical returns do not predict the future, but they do give us that potential opportunity. So would it make sense to explore how safe and productive growth strategies with the potential to safely grow your money up to double digits for your retirement planning? Or do you love the thrill of risk of losing money in the market, hoping those losses don't happen when you need the money the most? If it does make sense, should you check them out before or after the next market crash? If you think before the next market crash is the smart play, you should have a 15 to 30 minute discovery call. Look, nothing's for sale. We're going to see if you qualify for our strategies, and you decide if you're interested. And if now's the time, then click the link to Kurt's calendar in the description below to schedule your discovery call. If not, it's my hope, I truly hope this, that the next market crash doesn't wreck your retirement. Check out our financial literacy videos available on our YouTube channel, and we'll try to keep them updated when we add them in the description below. We'll try to have some links down below too. Thanks for tuning in. I hope you found some value in this.